Yes, thank you. Thank you. Thank you very much. Ethan, so I just shared my screen, and based on the way I see things on my end, you all should be able to hopefully hear me and see the screen. So welcome, welcome. As Ethan said, my name is Daniel Dubrovsky. I'm a senior strategist for dailyfx.com. Now, as Ethan mentioned correctly earlier, it's been quite an interesting year for financial markets. There's been a lot of volatility, and I don't necessarily think that we are behind us in terms of volatility. But this is more of a technical presentation. We are not going to be talking about the markets, and we're not going to be talking about my outlook, because this is called simulating risk management. Can unlucky traders be profitable? I want to focus on this topic of risk management and risk management only. So we're going to take off our market analysis hats, and instead we're going to put on our trading strategy hats instead. As we will learn, there is some amount of luck when it comes to trading, but we can use what's called risk management to help compensate for this luck. I want to stress here, right? Trading is not a get-rich-quick opportunity for the most dedicated and well-rounded participants. Everything comes down to risk and how your strategy is. All right. Now, without further ado, right, let's dive in here. And before we dive into the good stuff, right, please take a moment to read through the disclaimer one more time. I just want to stress here that in terms of what I'm going to be talking about here, this is of course my own opinion and my opinion alone, and sometimes of course those can be wrong, but as we're going to find out later, we can actually use simulations to try to create these interesting scenarios to help with our trading strategies, right? Moving on here, remember that CFDs are complex trading instruments and they come with a high risk, right? I usually like to say that using leverage is like a double-edged sword, and that can both amplify your gains but also do the same, remember, to our losses. And so the possibility does exist that you can see a loss in excess of your initial investment. Ethan talks already a little bit about myself. Just to reiterate here, my name is Daniel Dubrovsky. I'm DailyFX senior strategist. I've actually been here since 2014. Started as actually an internship, and basically I provide market insights of both fundamental and technical aspects. I'm actually currently pursuing a master's in quantitative economics at San Francisco State University, and lately I've been doing a lot of deep dive in data and trying to make models to predict, for example, the Japanese yen and whatnot. But as I mentioned earlier, this is more of a technical session. We're not going to be talking about my outlook on markets. Instead, we're going to be focusing on what's called risk management. Now, as traders, we must be able to consider luck and timing, and there's a way to do it, right? And some of the things I'm going to be talking about today, we're going to start off with a brief overview of what exactly is risk management, and then I'm going to introduce to you guys what's called a random walk trading experiment. We're going to use this random walk trading experiment to basically simulate someone trading over the course of many times. And we're going to use this data that we get from the simulations to create what's called an optimal risk-reward ratio curve. And we'll all talk about that in due time, especially towards the end. And we're going to be able to answer the question, right? Can unlucky traders still be profitable? But before we dive into that, let's start with the first part of this webinar, talking a little bit about risk management, what it is. And I already talked to you guys a little bit about risk management. To sort of set the stage here, I want to point out to you about a very famous investor and hedge fund operator. His name is Michael Burry. And if you've ever heard of him, he's been very famous for correctly predicting the US real estate bubble in the 2000s. There's a great movie created, which I highly encourage all of you guys to watch. It's called The Big Short. It came out in 2015. Really, really excellent movie, especially if you're very passionate about traders. But The Big Short essentially is a story about Michael Burry in the 2008 housing bubble. Now, Michael Burry funded this hedge fund called Sign Capital in 2000. And he was famously known for shorting the 2008 mortgage bond market, basically by swapping collateralized debt obligations known as CDOs. He made a personal profit of 100 million and 700 million for his investors before shutting down operations in 2008. And now one would think that Michael Burry is a godlike amazing trader, but the truth is there was an element of luck in his prophecy, because what basically ended up happening is that while he was correct about the housing market, his timing was off a little bit. He was a little bit early. As we know, the housing market started to top in the mid-2000s, and the full-blown financial crisis didn't transpire until a couple of years later. And so during this period, he had to make these payments to maintain his positions, losing actually a lot of money, so much so that he suffered an investor revolt, because some investors were worried that his predictions were inaccurate, and they demanded to withdraw their capital. But of course, Michael Burry persevered, and he did not basically allow to do that. The key takeaway here is that time is very difficult to account for. There's this very famous saying called where it's like, if you're right at the wrong time, then you're wrong, right? If Michael Burry was correct, but the timing of it was notoriously difficult. And as we're about to learn here, we can actually compensate for timing and luck using proper risk management. So let's talk a little bit about what is risk management, the general idea, right, and its importance. At the end of the day, risk management is a strategy to cut down your losses. In trading, risk management techniques involve things like using stop losses, right? If you have an idea for a trade, right, you should always know at what price you're going to get out in the event the market turns around. And you can use that with proper stop losses. You can also change your positioning sizes, right? Let's say you're a person who doesn't trade very frequently, and you have these big outlooks for markets, and you only trade maybe a handful of times per year, but you trade you hold these positions for a long time. You're a less frequency trader. So perhaps you could afford to take on more risk because you're not trading as frequently, right? The opposite of that is you're a high frequency trader. You trade more intraday, right? Maybe if you're a more frequent trader, it'd be more prudent to use less risk per trade. Know your exit strategy, right? That goes hand in hand with using stop losses, right? Again, before you place your trade, you should know not just your rough general, say, minimum target, but at the same time, you should know when you're going to get out of your trade based on your strategy. And also, let's make sure that we're using what's called optimal risk reward ratios. And basically what a risk reward ratio is how much you're willing to risk per trade. For example, a 2-to-1 risk reward ratio, basically roughly speaking, means let's say you're risking $20 and you shoot to make $40. That's a 2-to-1 risk reward ratio. A 3-to-1 risk reward ratio would mean, let's say your stop loss is such that you would incur a $20 loss, but your target is to make $60. That is effectively a 3-to-1 risk reward ratio. And what we're going to learn here down the road is that we can compensate for timing and luck with proper use of risk management, holding everything else in our trading strategy pretty much constant. Now, the importance here is that proper use, again, of risk management can help compensate for your luck, right? Even if your analysis is spot on, it doesn't mean that the timing will necessarily be in your favor. And as I'm about to show you guys, is your win-loss ratio even important in some cases? So let's take a closer look as to what I mean by a win-loss ratio, and when it might be important and when it might not be important. Let's say you trade 10 times, right? And let's say you're really good at being right. 80% of the time, you are correct in predicting the trend, right? So out of the 10 trades you placed, your first 8 trades are winners. And let's say you make $20 each, risking $20. So 1-to-1 risk-reward ratio. So after 8 trades, right, you would make $160. But what happens if your last 2 trades, you take on a lot more risk and you lose $80 each, right? Well, after you worked so hard, right, you placed 8 trades, you were right 8 times in a row. After 2 trades, losing $80 each time, it means you have now evaporated your gains. So even though you were right 80% of the time, you ended up basically walking away with nothing, which of course is better than losing money. Or is it actually? Because psychological studies have shown, right, that we as human beings, we are more adverse to losing things than gaining the same amount. What do I mean? Let's say you win $500 or 500 equivalent of your currency, but then the next day you lose 500. We feel a lot more negative about losing 500 than about gaining 500. And there's just something here to take away of that. And that, of course, can sometimes impact how we trade. So the key takeaways of this first section, talking about risk management, right, is risk management is basically a strategy to help us cut down on our losses, or at the very least, right, trying to be consistent and maintaining a strategy and trying not to deviate from it. And we can use proper techniques such as stop losses, risk reward ratios, adjusting our positioning sizes, depending on how frequent we are of a trader. But as we're going to increasingly find out, win-loss ratios aren't everything, okay? So let's move on to the really interesting stuff here that I have to present to you here. So I'm going to introduce to you guys what's called a random walk trading experiment. Now, before we introduce this simulation, let's talk a little bit about what is a random walk experiment. In a random walk experiment, right, the goal is to simulate someone taking the same number of steps many times repeatedly, applying rules so that each walk is basically treated the same. An example of this is, let's say we're going to play a game. And the objective of the game is we have a 6-sided die, right? And we roll the dice, let's say 100 times. And based on the outcome of the die, whether you get a 1 or a 6, that determines, say, how many floors you climb up a building, right? Some outcomes, right, it'll be positive. So you go up floors. Some outcomes will be negative. You'll go down floors. And after 100 rolls, we want to see what floor you end up. After we do that game, we're going to repeat this experiment hundreds of thousands of times. And doing so would give you a statistically meaningful interpretation of the game by basically producing a bell-shaped curve of outcomes. Now, we're going to apply this same game to trading, and we're going to try and simulate someone, instead of rolling the dice 100 times, trading 100 times, right? And this trader, right, we're going to give them an account starting balance, let's say $2,000. We're going to give them a positioning size, such as Every trade, they are risking 1% of their total account, which evolves, by the way, as they make and lose money. Then we're going to give them what's called a risk-reward ratio. How much money are you risking per trade? Are you risking $20 to make $20? Are you risking $20 to make $40? Right? Then finally, we're going to give this person luck. What is the chance that a given trade is correct or not? Right? If you bought or sold, doesn't matter which direction, right? What are the chances that you were correct? So now that I've laid out the rules, right, let me show you guys how this experiment works. It looks a little bit like this. Basically, I created a code in Python to simulate this game, right? So let's start from the beginning. At 0, right? This is the starting point. Someone who has a $2,000 account, right? They are risking 1% per trade. That means on the first trade, right, we're going to risk $20 with a risk-reward ratio of 1, which means we're risking $20 to make $20. Their luck we're going to set at 50%, meaning that on any given trade, there's a 50% chance they might make money or lose money. So, for example, going from 0 to the first trade, in this random sequence, it was a winner. This person, after the first trade, was correct. They made $20. So their new account balance is now here $2,020. But we're not done yet. We have 99 more trades to go. Their luck is still 50%, and their risk per trade is still the same at 1%, which means actually they're no longer risking $20. It's now something like $21, right? Because it's 1% of 2,020, right? This risk per trade stays the same whether you're making money or losing money, which basically means the more money you make, the larger risk you have, and the more money you lose, the smaller basically the risk you have. So someone who's lucky about half of the time, right, you have a pretty predictable outcome. After 100 of these trades, right, you arrive basically more or less at where you started. After 100 trades, your ending balance is 1,990, basically unchanged. You lost $10, but in the grand scheme of things, you didn't lose any money, which makes sense. You're right about half the time, right? And you're only risking $20 to make $20 on the first trade, and this holds the same, right? But this series, right, this 100 trades, that represents just one random walk, just one person trading 100 times. And just one person's worth of trading is not enough, right, to get a statistically significant interpretation. So what am I going to do? We're going to simulate this game 100 more times. That gives us something like this. So now what you're seeing here, right, is the same game that we were just looking at, just repeated randomly 100 times. You got the same each time, right? You have the same starting balance, the same risk per trade, the same risk reward ratio, the same luck. After 100 of these games, right, the average ending balance is 2015, right? It's still very close to more or less where you started, right? And you will notice, by the way, the more trades someone places, the more distributions like of outcomes you have at the end, the higher the variance is, right? Because let's say placing only 50 trades versus placing 100 trades, well, you're going to get a lot more different outcomes after 100 trades than you are after 50. So it's only natural that as you increase the amount of trades per game, you're going to have a higher distribution of outcomes. But this is all very predictable, because if you're right half of the time and you're only risking $20 to make $20, I mean, after 100 trades conducted many, many times, you're going to end up more or less where you started, which is not what you want, right? If the objective of the game is to be profitable, we're going to have to do something about this to fix this. But before we go into that, let me show you what happens when things start to go wrong. What do you suppose will happen when we make the trader a little bit more unlucky? In this example, they were right about half the time. Let's decrease their luck. How about they're only right 25% of the time? What do you think is going to happen? Well, let's revisit that first trade. Disaster strikes. The first trade, right, it's still the same, right? They're risking $20 to make $20. But now the only thing we have changed is how lucky they are. That's it. Everything else we've left unchanged. Holding constant, right? Ceteris paribus. Holding constant, right? Just changing the luck and holding constant everything else. We can see that after the first trade, they lost $20, which means their account shrank from 2,000 to 1,990. So the next trade, right, they're going to risk 1% of that. And because they're only right 25% of the time, well, they lost money again and again and again and again and again. They had a couple of winning streaks, but mostly it was losses. And you can see that just by decreasing someone's luck from 50% to 25%, after 100 trades, your new balance is 1,137. You have lost 43% of your account. And the only thing we changed is how lucky you are. Now, what do you suppose will happen if we repeat the same experiment 100 more times? Well, here we go. This is how that looks like. It's awful. It's horrible, right? The only thing we've changed is how lucky you are, holding everything else constant. After 100 trades, the average ending balance is 1,200. You are down $800, which means on average, you can expect to lose 40% after 100 trades. And you can see down here below, this is a distribution of outcomes. You can see it's very normal, very bell-shaped curve, which is what you want to see, because that's the whole objective of these random walks. You want to repeat these experiments many times to get statistically meaningful interpretations, right? So we need to fix this. And I'm going to show you guys how we can fix this. But before we do that, I want to go over some limitations of the study because, again, this is, think of it like in a box, right? We created a simulation with this code that I made. And a computer is not a human being. This is a simulation. There is no human emotion involved. The simulation assumes the person always sticks to the game plan and they do not change it, right? No matter how many times you lose, the computer will maintain the strategy. You're risking 1% of your account. You're risking 1-to-1 reward ratio, right? You're shooting $20 to make $20. You're always going to be unlucky 25% of the time, right? Your luck is 25%, and you're always risking 1% of your account. There's no human emotion involved in this whatsoever. The next thing I want to stress here is that we're not also taking account here for what's called slippage. Now, if you're a seasoned trader, you might know what I'm talking about here. Slippage is basically, let's say you place a stop, right? I want to make sure, for example, that my trade takes me out at this price. And by doing so, that means I incur exactly a $20 loss. Now, in the real world, right, you won't always necessarily be taken out at the exact price you might stipulate. And that all depends on the market conditions of what you're trading. More liquid investments, if you trade currencies, for example, they're the most liquid, you're more likely to run into situations where you can get stopped out at your desired place. But once you start moving out to a lot less liquid instruments, right? Stocks are less liquid than currencies, for example, and they are by no means the most liquid thing out there, right? Once you start moving to more illiquid instruments, slippage could become more of an issue. In this code, we assume that this person can perfectly execute their stop and target, by the way, without issue. and you're not going to be encountering the issue of slippage. Also, the simulation assumes someone trades exactly 100 times full stop. Whether it's their day trader, whether it's a position long-term trader, you only sit on trades for a while. The simulation assumes you trade exactly 100 times. It's not going to match everyone's level of activity for sure. But I just want to stress here, right, that what I'm showing you guys here is an example of what happens when we use proper risk management, how we can use risk management effectively, right? So this brings on to the last section of this presentation. We're going to answer the question, can unlucky traders still be profitable, right? That person who's lucky only 25% of the time, is it possible to make them profitable, right? So in order to be able to fix this problem, we're going to start changing one thing and one thing only, the risk-reward ratio. We're going to try to find what's called the optimal risk-reward ratio for someone who is lucky 50% of the time, 40% of the time, about a third of the time, 25% of the time, 20% of the time, and even 10% of the time. How are we going to go about this? As we're going to learn, we can compensate for luck and timing by increasing what's called a risk-reward ratio. So if you remember, right, in this simulation, we assume the person risks $20 to make $20. Well, we're going to introduce a new step to the code, and it's going to tell the simulation to increase the risk-reward ratio by 0.05 after every 100 trades, 100 of these experiments, if not all the balances ended above the starting balance. So I'll say this again so we can all follow along here, right? Let's remember, right, that the average ending balance for someone who's lucky 25% of the time was something like 1,400. What the code's going to do is it's going to look at the average ending balance, and it's going to see, for example, that not all trades after 100 times were above the starting point, which is 2,000. So it's going to keep increasing the risk-reward ratio, right, by 0.05 until all trades basically end up above the starting point. Then, once we find our ideal risk-reward ratio, we're going to repeat this entire experiment about 9 more times. And basically what happens is that millions of trades will be placed, so we can get, again, statistically meaningful interpretation. So I know that might be a little bit confusing, but let me show you guys what happens when you start changing the risk-reward ratio. So now, this is for someone who has 50% luck, right? So think back to earlier when we were looking at the person who was right about half of the time. All we did is we increased the risk-reward ratio, right, from 1 to 1.6. So we're no longer risking $20 to make $20. We're now risking something like, I think something like $34 or $35, right? So we're risking $20 to make $35, something like that. And so what we find, right, is that this code basically ended up increasing the risk-reward ratio. It would start at 1, it went to 1.05, went to 1.1, 1.15, 1.2. It kept going, and it stopped at 1.6. Because at 1.6, all of the 100 trades placed ended up above the starting balance of 2,000. And so you can see you get this sort of upward slope here at a 1.6 risk-reward ratio. And now the average ending balance is 2,700. And all we did here was change the risk-reward ratio. So on average, the average account, right, has now made a 36% profit. And all we did here was increase the risk-reward ratio for someone who's lucky about half the time. Now, what does this look like for someone who's lucky about 40% of the time? Well, it turns out the optimal risk-reward ratio from this code was 2.45. That means that if you're lucky about 40% of the time, the first trade, you're shooting $20 to make something like $50. And so the average ending balance, right, for someone who's lucky 40% of the time using an optimal risk-reward ratio ended up being a 46% return. So using this simulation, I've created what's called an optimal risk-reward ratio curve for someone who trades 100 times. It looks something like this. Someone who's lucky about 50% of the time, the simulation found that the optimal risk-reward ratio was 1.6. Now we're going to make them unlucky, 40% luck. Optimal risk-reward ratio seems about 2.45. If they're lucky about a third of the time, the optimal risk-reward ratio seems to be about 3.23 or so on average between the 10 rounds of experiments. At 25% luck, right? If you're correct only about a fourth of the time, it seems the optimal risk-reward ratio was 5.3. 20% luck, tried about 1/5 of the time, 7.3. If you are incredibly unlucky, and we made this trader very unlucky, right? They're only right once every 10 trades. Let me repeat that. If you're right only 1 out of 10 times on average, well, the code produced a risk-reward ratio of 21, right? Which is a lot, right? That's pretty big risk-reward ratio. So let's revisit our unlucky trader, right? If we go back to the last section, right? We dealt with a trader who was lucky about 1/4 of the time. In fact, just to remind you guys, I'm gonna scroll back a little bit, right? I'm gonna show you. I'm gonna show you guys that trader one more time. So this trader, right? The same sequence, right? He's only lucky about 25% of the time, and we're using a risk-reward ratio of 1. Well, what happens when we increase the risk-reward ratio to the optimal level defined by the code? So it's gonna be 5.29% or something like that. So and now the new risk-reward ratio is 5.3, but we left everything else unchanged. His luck is still 25%. Well, now look at this. On this first trade, he risked $20, right, in the hopes of making $100 or so. They lost money. They were down $20, and then they lost again, and they lost, and they lost. So 1, 2, 3, 4, 5. The first 5 trades were losers, but then he had 1, 2, 3 trades with a 5.3 risk-reward ratio, and all of a sudden, bam, he shot up a lot, and he lost a lot, and then he won a little bit, then he lost a lot, and then he won a little bit, and this was done 100 times. And after 100 trades, this trader is now profitable. The ending balance is now 2.8 grand. Right? So that brings us to the conclusion of this presentation and the key takeaways, right? As we learned, your win-loss ratio means nothing if you do not deploy proper risk management. I showed you how someone who's lucky just 25% of the time can, on average, still make a profit with proper use of good risk management. And again, there are limitations to this study, as I mentioned earlier. Again, this lives in a simulation, and there are no human emotion. There is no human emotion here factored into the equation, right? This person is assumed to stick to the game plan and will never deviate from the game plan. It also assumes there are no issues with slippage. It assumes you can always perfectly exit your trade at the given point, and your target will always be touched at the given point, right? And we also assume here that each person trades exactly 100 times, which doesn't match everyone's level of activity. Proper levels, right? We talked about those proper risk-reward ratios, right? But please be mindful that this study is more of a demonstration of the importance of risk management. These levels are in some ways arbitrary. They just exist in this confined simulation that I made. And really the key takeaway of this webinar is not specifically which risk reward ratio you should use based on how lucky you are. Rather, it's to demonstrate to you how we as traders can compensate for luck and timing, which are, especially timing. Our timing is very difficult. We talked at the very beginning about how Michael Burry, the famous investor who predicted the housing bubble, right? He was right, but it took time before the housing market fully collapsed, and he was able to profit off of that. And he suffered a revolt, right? An investor revolt, if you've seen the movie. Which, by the way, again, highly encourage you guys to watch that movie if you haven't yet. And so, again, to the key takeaway here, right, is proper use of risk management, right, can help compensate for the element of uncertainty and luck and timing. And I showed you guys how someone who's only lucky about 25% of the time can still make a profit. And I also demonstrate to you guys how someone who's lucky 80% of the time can still lose money. Guys, at the end of the day, it all comes down to risk management, right? And that is going to bring us to the end of my section. Now, I would like to open the floor to questions, but I don't actually see any currently in the chat. So what do you think, Ethan? Should we give the chat a few minutes? Yeah.
No worries. Yeah. So maybe if you guys have any question, just type it into the question box right now. But maybe, Daniel, for myself, I have one question. So
sure.
As I go through the presentation, great presentation, by the way, learn a lot on the optimization model on, risk reward ratio with luck. So assuming, let's say, if we are able to know our own winning rate, right? So from the IG trading platform, there is this tool called the Trade Analytics, and it actually tells traders what is their average winning percentage based on the trades they have actually done with IG. So let's say if we know that this particular trader has about a 40% win rate, and we know that the optimized risk reward ratio will be at about 2.45 based on this chart that you're showing right now. So assuming, let's say if we see like a trading setup, but this trading setup doesn't has this, the risk reward ratio based on certain key levels is not 2.45, does it mean that you're less inclined to take the trade?
Right. That's an excellent question. Because again, you have to think about what does it mean to increase, right, your risk reward ratio. It effectively means you're going to be holding on to winners for longer. And that's, by the way, another thing that separates the good traders from the really successful ones, right? They cut their losses short and they let their winners run. So by deploying this kind of strategy, right, it will teach you how to maintain your winners. It will at the very least give you an idea what your minimum targets should be. Does that help answer that question?
Yeah, that's. So we actually have some questions as well right now coming in from the audience. So Joseph, you are asking about the effects of brokerage. I'm not too sure what effects you are referring to. If you can elaborate a little bit more, that would be helpful. If you're referring to spread and things like that, just leave it in the question box as well. So if another question from Keith, so he's asking, does this assume this risk management applies to a single type of trade, or can it be applied to different instruments? So Daniel, what would you say? Is this applicable for all instruments, all product, all asset classes?
Yeah, for sure. So again, in this kind of simulation, right? Again, let's look at the variables that we used for trading. So basically, you have a starting balance, right? I have the risk percentage per trade, and a key thing here is the risk reward ratio. So the way, there are a couple ways, right, which you can use to get your risk reward ratio. The first one obviously is through the target, right, from whether you're trading currencies through CFDs or commodities and whatnot, or perhaps a certain equities, right? You're going to have eventually a target price, right? And you can play around with leverage and to get sort of close to your risk reward ratio. That's what I use. For example, when I trade currencies, I mostly trade currencies, and the way I get to these risk reward ratios in terms of the instruments is, when I set my stops and target, I then increase my position size to match the target risk reward ratio in that instance. And you should be able to do something similar of that in terms of that kind of market. Now, if you're not trading on a leveraged account, and let's just say you just trading a stock and there's no leverage and it's just stock, right? Then that would entirely be determined by how far basically the target is from the price. So.
Okay, so Joseph, your question is on brokerage will affect the outcome just like risk reward ratio. So maybe I can take that. So I think the brokerage doesn't really affect the outcome. It's mainly on your trade, right? Whether your risk reward ratio, whether your winning rate, that will primarily determine the outcome. But what the brokerage can affect should be the cost of trading, because it will impact the amount of profits that does your trade need to work a little harder to cover, to break even from that trade. So I hope that answers your question. Mainly, the brokerage will only affect the cost of trading. The outcome is still by the market mainly. All right, so maybe we can take one last question from our audience. Sure. So Daniel Jenkins is asking, to what extent does an increased risk to reward ratio reduce the win-loss rate?
That's actually a very good question, right? Because again, think about what a higher risk reward ratio means. It basically means that your target is further away, right? Your target is further away than your stop. Because again, you're holding constant, right? Your stop, let's say a 2.5 risk reward ratio, the target is 2.5 distance from the starting price, whereas your stop loss is a 1-to-1 distance. So the distance from your entry to the stop is going to be that 1-to-1 thing. So if you're shooting $20 to make $50, then the distance from your entry to your stop is going to be $20, but the distance to your target is going to be the equivalent of, let's say $50 worth of distance. So obviously, as you increase the distance to the target, that may reduce the probability that you reach that target, because it just simply further away. And unfortunately, this is not something that I took into account in this study. But again, I just want to stress here that this is not an end-all be-all sort of strictly defined risk-reward trading strategy. I'm merely demonstrating here how we can compensate for different levels of luck just using a simplified sort of scenario here with luck. And it should teach you, right, to let your winners run and cut your losses short. And that will help put you in that mindset and help make you a better trader, in my eyes.
Okay.
That's my answer.
All right. Thanks, Daniel. So we have one final question. So I think I can just take that one. It's the risk reward ratio profile versus luck percentage applicable to different scenarios? Yes, I think this should apply to whatever scenario, be it uptrend, downtrend, range bound. So it's just highlighting how the different risk reward ratios again can compensate based on a trader's luck. So before I pass it on to the next speaker, right, maybe just let me change the presenter back to myself.
Sure.
Okay, just give me 1 second. Let me show my screen. Okay, so if you are a client of IG's, right, I just wanted to highlight that we have this tool called the Trade Analytics. So once you are logged into the dashboard over here, right, so this tool is only available for live accounts. So if you're using a demo, you will not have access to this tool. And if you're having a live account, you need to place at least 10 trades, okay? So what you need to do is just log in. And in this dashboard overview, go under the live account tabs, click on these 3 buttons, these 3 dots, right? Click on this button called Trade Analytics, okay? So for myself, this is a live test account, so there isn't any data here. But if you have closed more than 10 trades with IG using your live account, we will be able to give you some sort of like an analysis on your trades, your average risk reward ratio for your trades taken, your average winning rate, what markets are you doing better, what markets are you not doing as good, and things like that. So actually there's a lot of information here under this Trade Analytics section. So if you are already trading with us but you have not explored this yet, I will recommend you and strongly encourage you to at least take a look at this to see how you can further improve. Okay, with that, once again, I want to thank you again, Daniel Dubrovsky, for your insightful sharing with us. Appreciate your time.
Anytime. Always my pleasure.